So today we're going to dive into one of the most powerful and honestly one of the most misunderstood ideas in finance, fat tails. It's a concept that really pulls back the curtain on why our world, and especially the world of markets, is just so much wilder and more extreme than we're led to believe.
All right, to kick things off, let's just ask a simple question. If you use the standard statistical models that basically run all of modern finance, what are the actual odds of a huge single-day stock market crash? You know, the kind that just completely reshapes everything for investors.
Well, the answer is kind of mind-blowing. Those standard models, they tell you that an event of that size should happen maybe once in the entire lifespan of the known universe. But we know that's not true. In reality, it's happened over and over again. So what on earth are these models missing? To really get to the bottom of this, we first have to look at the one tool we all learn about in school, the bell curve. It's the very foundation of how we're taught to think about probability, statistics, and, well, pretty much everything.
The bell curve, or the normal distribution, is just beautiful in its simplicity, right? It perfectly describes things where most of the action happens right around the average, and any crazy outliers are just incredibly rare. Think about something like the height of American women. Most are right around the average, about 64 inches. The chances of finding someone who's, say, 8 feet tall, it's basically a statistical impossibility.
But here's the thing. This isn't just some abstract concept from a stats textbook. The bell curve is the absolute bedrock of Nobel Prize-winning financial theories. We're talking modern portfolio theory, the Black-Scholes model, the very things that are used to manage trillions of dollars. Our entire financial system is essentially built on the assumption that the world is nice, tame, and predictable.
So, what happens when reality just completely refuses to follow that nice, elegant curve? What happens when the thing that's supposed to be statistically impossible happens, not just once, but again and again?
October 19th, 1987. You might know it as Black Monday. The S&P 500 dropped almost a quarter of its value in one day. Now, this wasn't just a bad day at the office. According to the models everyone was using, this day should not have even existed.
Yeah, to put that in perspective, a drop this big was what's called a 23 standard deviation event. The odds are so infinitesimally small, calling it rare doesn't even begin to cover it. According to the math, it was an absolute impossibility.
And here's the kicker. Black Monday wasn't some kind of cosmic fluke. The 1929 crash, the dot-com bubble bursting, the 2008 global financial crisis, the 2020 COVID crash, you look back and history is just littered with these impossible days. It becomes painfully clear that financial markets are playing by a totally different set of rules.
And this brings us to the big idea, the concept that explains all of this chaos: fat tails. This is the framework that helps us finally understand why the world is so much wilder than that neat little bell curve ever told us it was.
So a fat tail distribution is pretty much exactly what it sounds like. You know how the bell curve has those really thin tails that just drop to zero super fast? Well, these distributions have fat tails that stay way up high. And what that means is that extreme events, the huge crashes and the massive rallies, are way more likely to happen.
Just look at these two graphs. They show you the whole story. The one on top is the fat-tailed world. See how that line stays high way out from the center? That's the high probability of an extreme event. Now look at the bell curve below it. It just dives right down to zero. In a fat-tailed world, those extreme outcomes don't just happen sometimes. They actually define the entire system. And guess what? That's where financial markets live.
The thinker Nassim Nicholas Taleb actually gave these two worlds these great memorable names. The world of the bell curve, he calls that media creston. Think about it. If you put the tallest person in the world into a room of 1,000 people, the average height barely budges. But the fat-tailed world, that's extremistan. If you put the richest person in the world in that same room, the average wealth shoots through the roof. One single data point changes absolutely everything.
And this idea that one single event can dominate the entire system, that leads us directly to one of the most famous concepts to come out of this way of thinking, the black swan.
Now, a black swan isn't just any old rare event. It has three very specific traits. First, it's a total outlier, something completely outside of what we thought was possible. Second, it has an extreme, game-changing impact. And third, and this is the sneaky part, after it happens, we all start telling stories and making up explanations that make it seem like it was totally predictable all along.
And it's really important to separate this from what's called a gray swan. A gray swan is a huge event, like a really bad market crash, that's incredibly rare, but is still statistically plausible if you're using the right fat-tailed model. A black swan, on the other hand, is an event so out of left field that it wasn't even part of anyone's model to begin with.
And this right here is the one point that almost everyone gets wrong. The defining feature of these extreme events is not that they happen all the time. It's that when they do happen, their consequence, their impact, is so enormous that it can completely outweigh all the small, normal, predictable stuff combined.
Okay, so if we can't predict these crazy events, what do we do? What's the actual takeaway here? How are we supposed to operate in a world where the fundamental rules can be completely rewritten in a single afternoon?
The answer is a massive shift in mindset. It's about completely stopping the game of trying to predict the next crash or the next crisis or the next black swan. Instead, you have to focus on building portfolios and systems that are robust, systems that can survive and maybe even benefit from these extreme shocks when they come.
So this means using strategies that actually embrace the extremes. For instance, stress testing is like deliberately trying to break your portfolio in a computer simulation just to see where the weak spots are before a real crisis finds them for you. True diversification isn't just about owning a bunch of different stocks, it's about owning things that will act differently when everything goes haywire. And hedging, that's basically like buying insurance for your house. You use financial tools to protect yourself from a catastrophic loss. See the theme? It's all about preparation, not prediction. So let's just end with this question. Our models, our education, our intuition, it all pushes us to look at the average, the typical, the most likely thing to happen. But what if history? What if finance? What if life itself is ultimately defined not by the boring middle, but by the extreme, the shocking, the impossible events and the tails? What vital truths are we ignoring by always focusing on the average? And what kind of risks are we taking by looking away?